Hey guys, well, hope you had as good of a break as possible. Kind of nice here to get back a little bit to, I don't know, some normalcy, giving us something to do throughout the day. Anyway, happy Easter. I'm hoping that you're getting a chance to celebrate with some family, spend some even more time with them. Hopefully, you had a way to celebrate all that good stuff. We're moving on to Unit 4 today, and we're talking about monetary policy eventually. We're also going to get into the Federal Reserve, which is our monetary policy central bank. We'll get into that. Extremely closely related to Unit 3 and our aggregate demand, aggregate supply graphs. Um, and I can almost guarantee that with a question, however many there are on the test, will have something to do with this related to Unit 3. So an important unit. It's going to take us a couple days to get through. Hopefully, we can get good at it. You'll see though, if you could be confident after this particular unit, you're gonna be in really really good shape. So. Anyway, we'll get started here. You are on these notes. Okay. So kind of skipped a couple. They kind of went out of order a little bit. We're going to come back to these tomorrow or Wednesday. Okay. And these are the ones that we are on now. So we're going to talk about um, at the end of the day, what causes people to have the ability to borrow money. Okay. And just like anything else, borrowing money is just another purchase that we make. Okay, so that's what we've got to understand. That when I go borrow money from a bank, there's a few things that are going to affect how much money I'm able to borrow. If I can borrow more money, okay, then I can buy more stuff. Okay, which is basically what we want to be able to eventually make the connection between. So let's get some stuff going here. We're going to come back to, like I said, the Federal Reserve tomorrow. You can read some facts there. Our Federal Reserve is what is referred to as our central bank. Sometimes on the test questions, you'll see a certain country's central bank. Our central bank is the Federal Reserve. Anyway, if you've seen that guy, Jerome Powell, he's kind of the chairman of it. We'll talk more about that stuff tomorrow. Okay. So let's define, what we're going to count as money. Okay. And so there's two forms of money you need to know. First of all, M1 money, okay? This is money that we use on a day-to-day basis, all right? And notice we use this term liquid, all right? Um, Liquidity means the ease of it to spend, okay? So for example, like if I pull a dollar bill out of my pocket, I can spend that super super easy, right? I can use my debit card super super easy. Um, you could say that a debit card is a little bit less liquid than a dollar because I usually can't use my debit card at, say, a garage sale. But anyway, you don't necessarily need to know that. Know that again, this is money that I have in my checking account. Okay, not quite the same. A checking account and saving account, not the same thing. I can't spend money out of my savings account. Okay, I can take my money out of my savings account and spend it. Okay, but that's kind of one little step that we have to do. Okay, so that makes it a little bit less liquid. Now M2 money is going to be what's more important for what we're worried about in terms of banking. So M2 money is going to be all that, those dollars and things like that, and checkable bank deposits, and it's also going to include savings accounts. Okay, a money market account, as you see that on there, that's just a different type of savings account. You might also see time deposits. Okay, that's a different type of savings account. Basically, banks want you to have your money in them so they can loan that money out, right? That's how they earn money. And a money market account basically says, hey, listen, if you keep over, let's just say $5,000 or $10,000 in your savings account, then we will increase the interest that you receive on that account. So it's basically just a way to get you to keep more money in the bank, which in turn they can eventually loan out to people, right? It's kind of a guarantee that they have that money. They can't loan out your money in the checking account, okay? Because they don't know that it's going to be there. I can go spend money in my checking account tomorrow. They don't loan that money out necessarily, okay? They don't necessarily want to risk that. And we'll talk about some of the things, what happens if a bank loans out too much money on Wednesday, and how we're going to affect the supply of money as we move forward. Okay, so you want to understand that again, the money that I save in my savings account is accessible to people that want to borrow it, if that makes sense. Okay, so that idea of M2 money, that's the money people are able to eventually borrow. Okay, again, it doesn't include other assets like like property, right? So there's a difference between wealth and income. Okay, so like income is strictly dollars, right? Wealth are things that I can trade in for money. Stocks would be wealth or an asset. Property is an asset, right? Things that I can turn into uh, income that can make me have more money. Okay, so there is a little bit of a difference. I don't know if you need to know the difference of that, or the I don't know if you need to know the the specifics of all that stuff, but M2 money is what we're talking about when we say, okay, what can banks loan out? Okay, what is available to consumers? What is available to businesses to borrow? All right. Take a quick look here. Try to answer these questions. Pause if you need to. Larger your income, the more expensive a house you'll demand. That's true, usually, right? Up to a point. The more expensive a house is, the more money people will have to borrow to buy it. That's true. The invention, needs, and use of credit cards have increased the amount of money people borrow from banks. That's kind of true and false. Okay. It's false in the sense that I don't go get loans from banks. It's true in the sense that banks also have credit cards. Okay. And so, again, credit cards and the ease and use of being able to have those has increased how much money we demand, so to speak. And so, anyway, those are some things that if you can understand, you'll be set to go. Okay, so the graph that we're going to want to be able to become familiar with, and it's titled the loanable funds graph, okay, which is basically it's just a supply and demand graph for banks' loans. Okay, now the tricky part is, or what's different about this, first of all, notice here's our price axis. This is interest rate. Okay, here's our quantity, the amount of money that we borrow, right? And so, anyway, our price axis is still, okay, interest rate. We don't put a dollar amount, we put a percentage on it, right? So, 1% interest rate is cheap, 15% interest rate is expensive. And so, keep in mind that we are on both of these curves here, okay? We are the supplier of money, meaning that we put money into bank accounts, which if a bank account is going to, for example, say they're going to charge us $50 a month to have a savings account with the bank, okay, a negative interest rate, so to speak, we are not going to put money in there. Now, if a bank says, hey, listen, we're going to give you 10% back on your savings account, well, now we're going to want to keep our money in the bank. In fact, we'd probably want to keep it in the bank instead of the stock market, okay? In reality, banks give out about 0.1%. Okay, in terms of a normal savings account. Sometimes their money market accounts will get up to about 0.5%, 1%. There's these things, like I said, time deposits, which means I'm going to keep that money in there for at least 6 months usually, and they might pay 1.5%. But it's all relative to what the interest rates that are set by the Fed do, okay, the Federal Reserve. And again, we're not into that yet, but again, understand that if I can get money for keeping my money in a bank, I'm going to be more likely to keep it there, right? So we're both the supplier of money in banks and we're also the demander, right? We also have to borrow money, okay? And so when the interest rate's really high, we don't want to borrow any money. It's too expensive. We can't, right? When the interest rate's really low, we tend to borrow a lot more money. Okay, so whether that means money to buy a house, whether that means money to buy a car, a business, money to buy like a bulldozer, for example, those types of things. That's the graph that we need to understand. Nothing extraordinarily new, except for the fact, like I said, we're kind of the suppliers of the money too, right? The bank doesn't create money necessarily. Okay, the bank can create an income for a person that borrows money, but a bank can't necessarily just say, hey, listen, we're going to put some money in this safe so we can loan it out. No, they have to have customers in terms of savings accounts to be able to loan money. Okay, and so they're dependent upon people saving money in banks. Okay. The other graph is sometimes referred to as the money market graph. We'll become much more familiar with this tomorrow. Notice it has a vertical supply line, okay? And basically what happens is the Federal Reserve sets rules that say, hey, banks, you can only loan out this much money, okay? I don't want to over stimulate you with two different things here. If you draw this graph, with an upward sloping supply curve, it's going to look exactly the same anyway. You're going to get the same results. But we'll come back to this tomorrow when we Wednesday when we talk about the Federal Reserve. Okay, so if we shift our demand in the money market, okay, and so you can see our shifters here. We could have simply prices go up, so we got to demand more money to borrow. We could have our incomes increase, which means we qualify to borrow more money. Technology has decreased our demand for borrowing money in a formal basis, right, with credit cards. And so anyway, the bottom line is we need to know that when we shift our demand here, okay, that basically is increasing the M1 money, right, in our pockets for a short period of time. I'm going to take that money, I'm borrowing it, and I'm going to purchase a product with it, whether it be a house, a car, whatever, right? Both up from a consumer standpoint, both from a business standpoint, right, for investment. And so what we need to understand is when we shift our demand to the right, our quantity of money that's being spent is increasing to the right. Okay, and we're going to tie this into the aggregate demand graph here in a second and make some sense out of it. All right, and then if we change our supply, you can see that again our equilibrium changes, and again we'll talk about that significantly more on Wednesday. Notice we do bring our terms up over here just to give you a preview: expansionary policy, contractionary policy. Notice expansionary policy meaning we want to increase the supply of money, right? What happens to interest rates? Interest rates go down, meaning I'm going to borrow more money, meaning I'm going to spend more money, right? And we can simply, what we're doing is we're just putting it on a graph, okay? And so anyway, that's where we're headed. We got part 2 of this video. I'm going to relate this stuff to a couple other graphs here, and we'll move forward.